Hello everyone and welcome back to another video. Today we'll be talking about real estate waterfall distributions and other deal types. We'll be explaining to you briefly and concisely what waterfall distributions are, as well as other deal structures, and we'll also be providing you with a free Excel template at the end of this video that you can use today. Now, today's video will be a little more business oriented, so make sure you watch part 2 for a tutorial video on how to create your own waterfall distribution model in Excel if that's something you're interested in. Otherwise, if you're more here for the business aspect of things, then you are in the right place. Just before we jump into the meat of the video, I'd like to introduce myself. My name is Noe Perrin, and Streetwise Advisors, we are a group of real estate finance specialists and entrepreneurs. We come from a wide variety of background and experiences. Some of us are from investment banking, Merrill Lynch. Myself, I come from both an entrepreneurial background doing property management, real estate, fix and flips, as well as institutional experience working as an acquisitions analyst for a large real estate development company based out of South Florida, as well as an investment associate at a real estate private equity firm, structuring different real estate investment vehicles and funds, and thereafter doing portfolio management and reporting. So that is just a little bit about us. Going back to the main video, a waterfall distribution is just a means of sharing profits, and there are various ways for us to do that. So as a sponsor of a deal, you have various different options when you go to pitch a deal to an investor and provide them the means through which to invest. So typically this gets done through a joint venture agreement, and one of the ways that an investor can do so is with sweat equity, which is essentially where the sponsor puts a deal together, does all of the work, and gets a percentage ownership in the deal. The straight split is very similar, but here the sponsor gets a percentage of the profits larger than the percentage of equity that they put into the deal. So they're getting a split of the profits as opposed to an ownership percentage. Then there's the performance fee, where the sponsor gets an incentive based on the performance of the investment. And then you got the tiered waterfall, where the incentive is increased as the investment returns increase. So the sweat equity deal is very advantageous. It's one of the most common structures around when you're talking about small deals like fix and flips and things like that. From the sponsor's perspective, it's very great because you're immediately in the money from day one. So say, for example, like you have Dave here who puts 0% of the equity. He gets a 20% ownership. As soon as he closes that deal with Sue, he now owns 20% of the property even before a profit is made. And so that puts Dave in a really good position because he's essentially got equity without putting any money down from day one. So investors typically, they don't like that. So for the investors, that's actually a con. They don't like to give more than 10 to 20% away. However, for the investor, there are some benefits where they now gain a partner who's vested in the success of the deal and somebody to do all of the work essentially of managing that real estate investment. One of the things that you have to be careful about when you do a sweat equity deal is make sure you have some kind of exit or a buyout clause, because if you're stuck with a partner who let's say they're not cooperating or they're not performing, then you may not be able to get them out of the deal unless you already have a buyout clause in there or they agree to you buying them out. So that's something I always recommend my clients do, is always have a buyout agreement and always have a plan B in case things go sour. Not that that's usually the case. So here, as a quick example, Dave finds a property. It's worth $1.4 million that he can buy for $1 million. Dave brings the property to Sue, who's interested in getting into the deal. She agrees to buy the property and gives Dave a 20% ownership interest in exchange for managing the property. At the end of the deal, there's a $400,000 profit. However, because Dave has an ownership percentage, he actually gets 20% of the 1.4 million as opposed to just the 400,000. He therefore walks away with 280,000, and Sue walks away with 1.126 million. So here you can see that Dave is in a really good position. And I also just want to point out, let's say this property, something went bad, let's say the market went down and the property only sold for $1 million, then Dave would walk away with $200,000 and Sue would walk away with $800,000. And therein lies one of the limitations from an investor standpoint of the sweat equity structure. As a result, many investors are a little wiser than that, and they'll say, okay, let's do a straight split structure where maybe you don't put any of the equity in, but you just get a percentage of the profits as opposed to a percentage of ownership. And so that makes things a little more fairer, where now on the same example, this time Dave is getting 30% of the profits, but even though he's getting 30% of the profits, he's actually getting less than the first example. So here, the exact same deal, a $1.4 million property gets purchased for $1 million. There's a $400,000 profit. Dave gets 30% of that for $120,000, and Sue walks away with 70% of the profits plus her initial investment for a total of $1.28 million. Now, we're getting to the performance fee. This is where things start getting a little more interesting. Now, the performance fee otherwise can be known as a promote or a carried interest, and essentially what it is just a performance incentive that is based on the success of the underlying real estate investment. Now, performance fees typically have something called a preferred return, which in real estate is typically around 8%. So in today's example, we have Sue invest 100% of the equity and Dave runs the deal. Dave earns a 20% performance fee on all gains above an 8% preferred return. And so the preferred return, the reason why it's called preferred is because it is not subject to any performance fees until after it is met. So before an 8%, there's no fees charged. Anything after an 8% return, so let's say the deal makes a 12% return, the difference between 8 and 12 is 4%. That 4% would be subject to a 20% fee. So from the investor's perspective, it's very similar to the straight split, other than more of their profits are being excluded from having a fee assessed on that. And so that is a little more advantageous to the investor. From a sponsor's perspective, it's a little easier to sell, and it's also another way for you to earn compensation. This chart right here visualizes how the performance fee is calculated or how it's taken over time. So this black line represents the profitability of an investment. And so as the investment is more profitable along the x-axis and it passes the 8% return, there's now a 20% fee being applied on all future gains. And as such, this gray area right here represents Dave's performance fee, and the blue line here shows Sue's return, which is a little less because of Dave is now taking some of the profits as well. And so some of you may be wondering, why is it called a promote or a carried interest? And the reason why it's sometimes called a carried interest is the performance fee is not always taken as cash. It can sometimes be taken as a equity stake or an equity interest in the property, and that interest can carry over in time until the end of the deal. Let's say it can be rolled over and carried into the future until at the end of the deal, when all the properties are sold and cash is returned to all investors. And so that's why it's called carried interest sometimes. Moving forward to the tiered waterfall distribution, it's very similar to the performance fee, other than that the performance fee increases as the investment return increases. And so this is really a way to incentivize sponsors to really overperform, and really enhances the sponsor's profit potential if they have a very successful deal. So an example here would be if the investment yields between 0 and 8%, there will be no fee paid to the sponsor. For the investment returns between 8 to 16%, a 20% fee would be applied. For the investment returns between 16 and 24%, a 30% fee is applied. And for anything over a 24% return, 40% of the profits will be going to the sponsor as a performance fee. So as you can see here, this can be very advantageous to the sponsor, and especially in deals where this could be a home run and the returns are very high, I would definitely consider doing this type of structure because it can be very profitable to the sponsor. One of the cons of this as a sponsor is that it can be a little complicated to calculate and explain to investors that are not familiar with the structure already. And that's where a company like Streetwise Advisors can come in, and we can provide you the financial expertise and sell your clients or your investors and really help them understand and make clear this type of structure and help you structure the most profitable deal for yourself. And so from an investor's perspective, again, it's an alignment of interest. It helps the sponsor want to perform well. And as a con, however, if there's a home run, you do give away a lot of your upside as performance fees. And you may be giving an incentive to the sponsor to really maximize the financial return of the deal rather than act and therefore maximize the risk instead of being more balanced. So you got to be aware that these types of structures really incentivize the developer or the sponsor to really maximize their return. So a very common structure would be 0 to 8%, there's no performance fee. 8 to 16, a 20% performance fee. 16 to 24, 30% performance fee. And anything over 24% goes 40, 60, 40% going to the sponsor. So this type of structure is most commonly seen in ground up development deals, but it's sometimes also utilized in fund structures as well as value add type acquisitions. This chart here shows visually how the fee is applied. So again, here as the investment return increases, you can see here there's no fee. Then between 8 to 16%, there's a 20% performance fee. Then there's a 30% performance fee between 16 and 24. And after a 24% return is met, then there is a 40% performance fee on anything after that. So you can see the slope of the line is getting more horizontal as the incentive benefits Dave, the sponsor of the deal, more. And you can see that here by how big his promote or his performance fees in this section as opposed to here. So again, the sponsor is really incentivized by strong upside in these types of situations. And so going back to the typical waterfall structure, you could structure this in different ways. So for example, let's say you have a deal that you think will have a really good upside. Let's say you think it's going to do a 36% IRR. What you may say to your investors, say, okay, I will reduce the 8 to 16% hurdle down to 15 and 25%, but anything over a 24% IRR, I want 60%. If you think the deal is going to do great. Now, if you think the deal has less chances of outperforming and you want to be more conservative, then maybe what you tell the investor is, okay, the 40%, I'll lower the 40% down to 30% or 35%, but I want 25% in the 8 to 16% range because you know you're going to hit that hurdle. So how you set up the waterfall distribution can be negotiated between the sponsor and the investor, and that's something we can also assist you with to really optimize the financial strategy and the terms that you come to do with. Now, there's also such thing as a hybrid structure where you can combine multiple of these structures to really benefit you. In this example, Dave finds a piece of raw land with potential to be developed into a multifamily building. The land is located in an opportunity zone, which provides additional tax benefits to the investors. One downside to the opportunity zone program is that the property must be held for 10 years to get the maximum benefit. Now, the reason why this can be a problem is sponsors typically want to be in and out of the deal as quickly as possible because as a developer that is incentivized by performance fees, you want to crystallize and take your fees as soon as possible because that is where most of your returns and compensation comes from. So when you have a deal that closes in 10 years, that means potentially you're not going to be seeing any substantial checks for 10 years. So what we can do to change this is create a structure that has more than one type of profit splitting. So in order to structure an incentive, Dave and Sue strike up the following deal. Dave will put up 10% of the equity. Sue will put up 90%. Once the building is built and cash flowing, Dave will get 30% of the cash flow and Sue will get 70%. So here we can see that by structuring a straight split, as soon as the building is complete on operating cash flows, we can give Dave some additional incentive. And so what we're doing here is bifurcating the financial returns from operating cash flows and capital event cash flows. Because when the building is sold down the line, the profits from the sale of the building will be split via means of a tiered waterfall distribution. So while the building is operating, Dave is getting a straight split on the operating profits, and then in the LLC agreement, we're making a distinction between operating profits and capital events, where our capital events go through a tiered waterfall, which would potentially allow Dave to earn more and to have an incentive that's based on the IRR of the sale. And so that's just one of the ways that we can structure this. You know, as a sponsor, we can do many things. We can do management fees, acquisition fees, disposition fees. There's a lot of ways to structure these deals, and that's why you always want to be talking to a knowledgeable and experienced person that can give you some ideas and show you how to execute on this. So in conclusion, we learned about the different deal structures, their pros and cons. See the links below for a free Excel template that you can use today. Again, you can watch part 2 for a technical explanation. And if you're looking to access our expertise, you can schedule a free call with us by seeing the links below. Again, my name is Noé Perrin. We've helped multiple investors help their dreams come true by providing them expert financial services, doing fundraising for them, speaking with banks, creating professional investor materials that gets the point across in terms of how sophisticated and really highlighting why they should be investing in you and with you. And so once again, if you're trying to see your deals to success, make sure you reach out to us today. Please be sure to subscribe. If you have any questions, feel free to put them in the comment box. I would love to answer your questions there. So once again, this is Noé. I hope that you enjoyed this video, and I will see you in the next video very shortly. Thanks again.